Welcome everyone to another of our weekly investment manager videos, and many thanks once again for tuning in. With bond yields on the rise again and central bank asset tapering on the cards, it seems as if the only game in town is equities. But yet, with current valuations of US equities at historical highs, is it time to look perhaps a little bit closer to home? Well, today I have the huge pleasure in talking to James Sym, manager of the Mercantile European Fund, on the opportunities across the continent and how a certain approach to ESG investing can deliver both positive outcomes and returns. But first, before we get into the content, once again, if you haven't subscribed, it would be wonderful if you could do. It really does help us in putting forward our financial planning and investment management content. So, begging for subs out of the way, let's get onto it. James, many thanks for your time today. It's really good to speak to you once again. First off, you pride yourself in being a pragmatic contrarian. Are you seeing a recovery in Europe, and how are you currently positioned for that?
The very simple answer to that question, Andrew, is yes, we are actually. We've seen a recovery actually in a lot of areas. For example, anything exposed to China or Asia, which in Europe means a lot of sort of industrial businesses, done fantastically well. And people will be experiencing that as well in their daily lives, as it were, because they'll have seen the impact of some of those areas of inflation actually coming through in some of those industrial goods, perhaps if they're doing an extension on their house or whatever. But where we haven't yet seen a recovery, and this is, I suppose, to the second bit of your question, how are we building a portfolio for that? Where we haven't seen a recovery is really in the consumer. And we probably all know from our own personal experience that our personal balance sheets have actually been pretty good through a global pandemic. And that's definitely the case in Europe. Had similar schemes like the furlough scheme. But of course, they haven't been able to get out there and spend yet. And that's because as a result of wanting to control coronavirus, we obviously restricted the activities that people can take part in, whether it's going on holiday or going to a restaurant. So that's just starting now in Europe, and that's really is quite an exciting point, really in the cycle, I suppose, to have a look at the region, because you've not yet seen that recovery. Share prices haven't yet reflected that. So if you can get in now, and we see the recovery come through, which we're at over 70% vaccination in Europe for first jabs today. We're starting to release the restrictions. So as we see that come through, you should see a response in the share prices of those companies. So it's a slightly nuanced answer. We are seeing a recovery, and there's still areas we can get into in anticipation of that. And that's why I'd be, as you alluded to, quite positive on Europe.
That's good. So at least we haven't missed the boat, or those of us aren't allocated to Europe haven't missed the boat yet. You touched on valuation. Now I know that you are price conscious, certainly as an investor. Looking at the topic that seems to be everywhere, certainly in the trade press at this moment in time, ESG. How are you approaching ESG, given that most highly rated ESG stocks are rather expensive?
Well, I think I'm on record as saying there's a lot of ESG bubbles out there from 2 years ago, and some of those bubbles have only got bigger. So I'd agree with the sort of premise of your question. My thinking on ESG has evolved a bit, though, Andrew, over the last sort of 12 to 18 months, because the way we've approached ESG, let's focus on the E, let's focus on the environment. The way we've approached this sort of energy transition, the environmental transition as a industry, isn't it? Is we've said to our clients, look, here's a portfolio full of companies with low carbon emissions, and that's good. That's broadly how people have approached the issue. And there's a couple of problems with that. The most obvious one, from an environmental perspective, is we've got this climate emergency. We've got a climate problem, and we've still got all these companies making low carbon emissions. So just by owning the companies that, because perhaps they're asset light business, perhaps they're a services company, they naturally have low carbon emissions. It isn't actually solving the problem. we are sat, I can see now, we're all both sat, and everyone watching this is sat in a glass, cement and steel building. Mm-hmm. And there's a few billion people in the world that would also like to sit in glass, steel and cement buildings, in India and in emerging markets more broadly in Africa. And that's a good thing. Now, steel emits about 8% of the world's carbon dioxide. So it's the third biggest country. If it was a country, it'd be the third biggest country in terms of carbon emissions. Wow. And the same is true for cement as well. Mm-hmm. So these are big industries that need decarbonising. I'm picking on these two particular industries. So what we really need to do, if we're really going to make a difference to the world, if we're really going to make the world a better place and end up with a better outcome from a climate perspective, we need to find a way to help those industries decarbonize. Mm-hmm. And the only way to do that is through companies, because it's the companies making the stuff. Yeah. So that's how we're approaching the issue. It's about helping support companies who are significantly improving in that perspective, and also supporting companies by investing in them and also engaging with them, who are enabling other companies to make that transition. Yeah. And that is actually going to make the world a better place. If I can find a business, and we own some in our portfolio, if I can find a company that is able to produce steel in a clean way or a cleaner way than the current very polluting process, then that's actually going to make a big difference, much more of a difference than investing in a few more million quid in Nestle, which is a very carbon light AAA rated company. So that's the approach we're taking. Now, you mentioned valuation discipline. So we've got a happy coincidence here. We're actually doing the right thing and making the world a better place is aligned with investment performance. Yeah. Because if you can buy those companies that are, if you like, under the radar, we've called them ESG improvers, environmental improvers, haven't we just now, and enablers, and they're a bit under the radar, and the stock market hasn't yet reflected that opportunity in their share prices, then as a contrarian, as someone who thinks about the valuation of the businesses he's buying, as someone with that valuation discipline at the sort of core of the investment process, it's very aligned with this kind of approach of finding, underappreciated companies. Perhaps they didn't grow particularly well in the previous cycle, which is why they're cheap, but they've got this big opportunity relating to ESG. So in my portfolio, you won't find all the usual suspects, if you like, from an ESG perspective. But what you will find is lots of companies that are actually doing a huge amount to make the world a better place. And that's how I'm approaching the issue. And I think it's a way that should generate some value for clients over time.
And finally, just to kind of summarize all of that, we've got opportunities on consumer recovery, we've got opportunities in ESG. So currently, what does your portfolio actually look like in terms of the size of the companies, in terms of geographical spread, in terms of the sectors? What's a quick roundup of what we're looking at this moment?
Yes, so my sort of broad big picture view, Andrew, is that this cycle is going to look very different to the previous one. And there's a number of reasons for that. But the key one really is that it's not just the central bankers doing the heavy lifting anymore. It's governments as well. And the problem in the previous cycle, particularly for Europe, you mentioned Europe at the beginning, particularly for Europe, was a lack of end demand. Cutting interest rates to zero and then negative and printing a load of money didn't encourage consumers and businesses to spend. That was a problem of demand. So this cycle, governments are stepping in. And we know through furlough and the other various schemes that we've had over the last 12 to 18 months through the pandemic, that's been the case. But it's also the case going forward. And that's going to mean that there's a number of industries that are going to see a much tighter supply-demand dynamic and therefore going to have better pricing power. And ultimately, what does that mean? It means inflation. Right. So my big picture view, Andrew, is you're going to need a very different portfolio from the one in the previous cycle. So we've got three things really that we're trying to achieve with our portfolio. One is give clients that inflation protection. So that means not having a load of growth stocks that are very exposed if the market if the cost of capital goes up because they derate a huge amount. So that's the first thing. And we've actually written quite a long piece on the characteristics you would want in a more inflationary environment.
Okay.
So it's not just about the valuation of the companies, it's also to do with their business models, how capital intensive they are. Actually, capital intensity can be good in that environment. So that's the first thing. The second thing is, as you say, the consumer recovery. So you won't be surprised to hear, as a business cycle investor, I'm very overweight consumer cyclicals, because that's where the opportunity is. And then the third thing is that we call it environmental, but broad beneficiaries from this change in policy, this fiscal spend. So whether it's Saint-Gobain that struggled to grow in the previous cycle, but we think it's got a much better outlook, to a cable company making the cables to connect up the wind farms, those are the type of businesses that are going to see a much better demand environment. So that's the sort of three things the portfolio can offer, I suppose, and it's effectively geared for a European recovery over the next 2, 3, 4, 5 years.
I think it's fair to say that we're in fascinating times with regards to the changes that we're seeing, from monetary and fiscal perceptions, and then the reopening of the economy and the demand for more environmental solutions, more solutions to world problems. It is a fascinating time, and all of these issues create opportunities, and you're right, you need to have that pragmatism, you need to have that real focus on what the world is like, how it's changing, and not being scared to invest into those. James, it's been an absolute pleasure once again to sit down and talk to you. Thank you very much for your time today. You stay safe, and I'm sure we'll catch up soon.
Cheers, Andrew. Thanks.